Hello students, welcome to EPG Pathshala. I am Dr. Manjeet Singh from Punjabi University Patiala. Today we are going to discuss about a module on the union and state budgets and economic stabilization under the paper Business Environment. After completing this module, you should be able to understand the concepts associated with economic stabilization in the country through the various state budgets and the union government budgets. You should be in a position to understand the fiscal policy and its components. You should be in a position to describe the various components of fiscal policy and the government regulations, the various sources of revenue for the government, and the various areas of disbursement of the government expenditure. The problem of stability, when we talk about economic stabilization, it refers to a recurring phase of upward and downward cumulative movement in income, employment, and prices in an economy. Stability means the steady, non-inflationary economic expansion. The role of fiscal policy in promoting economic growth and stability was recognized during the Great Economic Depression in 1929. Manipulation of effective demand through deficit financing and surplus budget created the principles of functional finance. The anti-depression policy aims at increasing the effective demand through the expenditure and taxation policy. Public expenditure may be increased through public investment and consumption and with the encouragement of private companies. Expenditure policy says that investment on public works like roads, dams, and other infrastructure projects can be changed in a planned way. Though the work cannot be stopped midway without incurring any losses. But it is difficult to counteract inflation through expenditure, and it is equally difficult to curtail expenditure on welfare and defense. Taxation policy rests on the principle that taxes act as built-in stabilizers, since taxes depend upon income, prices, and production. Now, the system itself creates a surplus during inflation. Increase in the direct and indirect taxes would reduce the consumption and investment. So, it is a noted observation that fiscal policy is more successful in deflation rather than in a boom time. Now, let us try to see that what are the revenues of the central government. And in this section of the module, we will be in a position to describe the revenue budget. The estimates of receipts on revenue account have been grouped into two broad categories: tax revenues and non-tax revenues. The following table shows that the total current revenue of the central government consists of tax revenue and non-tax revenue. This has been rising quite fast, partly on account of more taxes and higher rates of taxes, and partly due to inflation. The total revenue receipts of the central government was little more than 400 crores in the year 1950-51, but it rose to 12,830 crores in 1980-81, and in 2010-2011 budget it was 6,82,212 crores. Between 1981 and 2010, the revenue receipts has increased by 53 times. Stabilization of underdeveloped countries. Economic stability is seen generally due to external instability. Exports of underdeveloped countries consists of primary products that are sensitive to the demand. Anti-depression policy in this case can be referred to as deficit financing, which is a step to counteract depression. A fall in demand originates abroad, and hence stimulating internal demand is not seen as a curb to depression. Import restriction may encourage local domestic industries, but lack of resources may act as a constraint, and therefore the policy should take care of both the imports and expenditure due to import restrictions. Private investment and consumption is encouraged through subsidies. Consumption may also be increased through the transfer of income. A general reduction in taxes or abolition of some would push up profits and reduce prices through a reduction in the cost supply. Prices are expected to increase demand. A reduction in export duties and imposition of import duties would boost up internal market and trade. Taxation policy gives the opportunity of boosting demand on elastic items. For encouraging investment, special tax concessions and schemes are made. Fiscal policy. In a mixed economy pursuing planned economic development, fiscal policy plays a central and multidimensional role if the government creates and sustains the public economy consisting of the provision of public services and investment. At the same time, it is an instrument for the reallocation of resources according to national priorities, redistribution, promotion of private savings and investment, and maintenance of stability. Fiscal policy is the policy under which the government uses its expenditure and revenue program to reduce the desirable effects on national income, production, and employment. In other words, fiscal policy is a technique used to attain full employment by manipulating public expenditure and revenue in such a way so as to keep equilibrium between effective demand and supply of goods and services at a particular time. Tools of fiscal policy. The following are the major tools of fiscal policy of India. Number 1, taxation. Number 2, public expenditure. Then public debt, deficit financing, budget announcements. Union budget. The policy of the Government of India to promote and avoid undesirable effects on the economy through taxation, government expenditure, and debt management is called as fiscal policy. The implementation of fiscal policy is through annual budget exercise. The budget depicts a complete picture of the estimated receipts and expenditures of the government for ensuring ensuing financial year. Union budget is an important event which has a great significance for the entire nation and is normally introduced in the last week of February every year. The budget is prepared and presented by Finance Minister before the Parliament. The finance bill of the budget has to be passed in the Parliament to approve the tax proposals, and appropriation bill has to be cleared to authorize expenditure. In the budget, a distinction is made between the revenue account and the capital account. The revenue account can be classified into revenue receipts and revenue expenditure. Similarly, capital account is classified as capital receipts and capital expenditure. In simple words, the government proposes its plan to raise resources through annual budget and is divided into two accounts, that is, revenue receipts and capital receipts. These can be explained in detail as follows. Current or revenue budget. The revenue budget of the central government deals with the receipts from taxation and from non-tax sources and expenditure met out of these sources. Tax revenue come broadly from these sources: tax on income and expenditure, tax on property and capital transactions, taxes on commodities and services. Non-tax revenue consists of currency, coinage, mint, interest receipts and dividends, other non-tax revenue. Current expenditure or revenue expenditure is made out of current revenues. Revenue expenditure is on general services as general administration, including police, judiciary, defense, collection of taxes, etc. Secondly, social and community services such as education, medical and public health, labor and employment. Thirdly, through economic services like agriculture, industries, transportation, trade, etc. Capital budget. Capital budget of the Government of India, also known as capital account, consists of capital receipts and capital expenditure. The capital receipts of the central government are composed of net recoveries of loans and advances made preciously to the state governments, union territories, and public sector undertakings. Net market borrowings, that is, gross borrowing from the market less repayment of the public debt. Net small saving collections, like gross collections less share of states, and other capital receipts such as provident funds, special deposits, etc. Capital expenditure of the union government consists of expenditure on capital items, mainly in the form of loans to the states and union territories for financing planned projects, and other capital expenditure on economic development, on social and community development, and capital expenditure on defense. The following table depicts a summarized central government budget since 1950-51 for selected years to show the growth of receipts and disbursement of the Government of India during the last 60 years. From this table, we may notice that in the revenue account, the receipts increased from 406 crores in 1950-51 to 6,82,212 crores in 2010-2011, whereas the expenditure increased from 347 crores to 9,58,724 crores in 2010-11. And when we look at the revenue surplus or revenue deficit, India was revenue surplus in 1950-51 to the tune of 59 crores. But afterwards, the revenue deficit has been observed for the later years as given in the table. If we look at 2010-2011 figures, the revenue deficit was 2,76,512 crores. When we look at capital account, the capital receipts were 120 crores in 1950-51, which increased to 4,26,537 crores in 2010-2011. Whereas disbursements, which were 182 crores in 1950-51, they rose to 1,50,025 crores in 2010-2011. And as we can see that in 1950-51, the capital deficit was 62 crores and it increased to 2,76,512 crores in 2010-2011. Overall, we can say that the budgetary deficit has been increasing ever since we have got independence. There was an enormous increase in public expenditure of the central government, which was due to expansion of government machinery, new responsibilities, new departments, increase in the government staff, increase in the defense expenditure, and continuous increase in the salaries and the dearness allowances of the government servants because of rise in prices and the consequent rise in the cost of living and huge increase in the interest payments. It is clear that between 1951 and 1981, capital disbursements exceeded capital receipts. Thus, there was deficit in the capital account too before 1981. The overall deficit was calculated by considering both revenue deficit and capital deficit. As we can see, this table shows the figures related to revenue account, capital account, and overall budget deficit or surplus from the year 1950-51 up to 2010-11. We can see that initially our country was a revenue surplus country, but gradually it raised to a revenue deficit country. In terms of capital account, we have seen that there was a deficit, but in 2010-2011 it was surplus by 2,76,512 crores. And when we look at the overall deficit or surplus, the situation has deteriorated over a period of time. In 2010-11, the budget provided for a surplus in the capital account to the tune of 2,76,512 crores, which covers fully the deficit in the current account or revenue account. The overall budgetary deficit is nil. This is just an artificial method of raising capital surplus through market borrowings, collections of small savings, etc., to cover up the revenue deficit. Actually, borrowing from the market, mobilizing small savings, and incurring other liabilities are bad for the economy. This is now designated as fiscal deficit. Formerly, it was called deficit financing. Now let us talk about the revenues of the state government. The tax revenue of the states consists of two parts. First is revenue from state taxes, comprising broadly of the taxes on property, capital transaction, and taxes on commodity and services. Second is the share in the central taxes. This source of tax revenue to the state is known as non-tax revenue, and it consists of the grants from the central government. States' own non-tax revenue includes the interest receipts, the dividends, the profits, the general services, of which state lotteries are most important in many of the states, and other social and economic services. Under the Indian Constitution, the state government have been entrusted with the important function of maintaining law and order, and also with many nation-building activities such as education, public health, medicine, irrigation, agriculture, etc. Like the union government, the state governments too have adopted the policy of building up welfare states, that is, raising agriculture and industrial prosperity of the state and looking after the needs of the poor and downtrodden. This table shows the revenue of the central government in the revenue account. As we can see that the tax revenue increased from 357 crores in 1951 to 5,34,094 crores in 2010-2011. And the non-tax revenue increased from 49 crores in 1950-51 up to 1,48,198 crores in 2010-2011. And when we look at the total revenue receipts, it was just 406 crores in 1950-51, which was raised to 6,82 crores 212 crores. Tax revenues. Tax revenues includes taxes on income, for example, income tax, corporate tax, interest tax, central taxes on property, wealth tax, estate duty, taxes on commodities and services, central excise duties, etc. When we look at the comparative position of direct and indirect taxes of the central government, in year 1950-51, the direct tax proportion was just 43% and indirect tax proportion was 57%, because direct taxes were to the tune of 174 crores and indirect taxes were to the tune of 227 crores. But as we progress, we have seen that the direct tax collection has gone up. It has gone up to 4,300,000. In 2010-2011, the direct taxes were 4,30,000 crores and indirect taxes were 3,16,651 crores. And the proportion of direct taxes was 57.6 crores, whereas the proportion of indirect taxes was 42.4%. Non-tax revenues. Besides taxes on income, property, and commodities, the central government gets revenue from the other sources also, which are collectively called non-tax revenues. These non-tax revenues includes receipts from fiscal services, interest payments, dividends, and profits of government enterprises, general services, etc. The growth of non-tax revenue in the recent years can be seen from the following table. In the year 1970-71, the interest receipts were just 590 crores, which have increased to 19,253 crores in 2010-2011. Dividends and profits, which were 120 crores in 1970-71, they rose to 51,303 crores in 2010-2011. Fiscal and other receipts, which were just 180 crores, they rose to 77,556 crores in 2010-2011. Interest receipts comprise of interest on loans to the states and union territories, interest payable by railways and postal services, and other interest payments. Profits and dividends relate to profit of RBI, profits of nationalized banks, LIC, etc. Fiscal services include the revenue received by the central government from currency, coinage, mint, etc. Expenditure of the central government. The following table summarizes the revenue expenditure of the central government for the selected years. And the years selected for this particular analysis are 1950-51 up to 2010-11. As can be seen from the table, the revenue expenditure in 1950-51 was 350 crores and the capital expenditure was 180 crores and the total expenditure was 530 crores. And from 1950-51, we have seen a big increase in the revenue expenditure, capital expenditure, as well as total expenditure. In 2010-11, the revenue expenditure was 9,58,724 crores. Capital expenditure was to the tune of 1,50,025 crores and the total expenditure was 11,08,749 crores. There has been a tremendous increase in the expenditure of the central government, particularly in the revenue expenditure financed through current taxation and other current non-tax revenues. We can see from this particular table that the non-plan expenditure on revenue account and capital account, that has also increased during the set period. In 1989-90, the non-plan expenditure was 64,500 crores, which increased to 7,35,657 crores. On revenue account, this expenditure increased from 52,130 crores in 1989-90 and it has gone to 6,43,599 crores in 2010-11. When we look at the planned expenditure, the increase has not been that big. On the revenue, total plan expenditure, which was 28,400 crores, it increased to 3,63,090 crores in 2010-2011. On revenue account, this was just 12,070 crores and it increased to 3,15,125 crores. And on capital account, it was just 16,330 crores in 1989-90, which increased to 57,967 crores. The central government adopted a new classification of public expenditure from 1987-88 budget. Under this classification, all public expenditure is classified into non-plan expenditure and plan expenditure. Budgets for state governments. In India, each state government prepares its own budget of income and expenditure every year. The following table summarizes the budgetary position of the states since 1951-52. As we can see that the revenue account and the capital account details are given from 1951-52 up to 2009-2010. Revenue receipts have increased from 396 crores in 1951-52 and they have gone up to 8,04,943 crores in 2009-2010. And expenditure has increased with manifold increase, which has resulted into revenue deficit in 2009-2010 to the tune of 32,295 crores, whereas in 1950-51-52 the revenue account was surplus to the tune of 4 crores. When we look at capital account, the capital receipts were just 137 crores in 1951-52, which increased to 22,514 crores in 2009 and 2010. And disbursements increased from 189 crores in 1951-52 to 2,18,540 crores in 2009-2010. So, on capital account, we have seen that there has been a surplus, and when we look at the overall surplus or deficit, we have seen that the overall deficit was just 48 crores in 1950-152, which rose to 26,721 crores. This table indicates that the receipts and expenditure of states on revenue account have been continuously increasing. For instance, in 1950-51, the current revenue of the state was mere rupees 396 crores, which rose up to 16,290 crores in 1980-81. So the states have generally managed to get overall budget deficit, meaning that aggregate disbursements are below aggregate receipts. The current revenue of state governments. State governments in India collect revenue from different sources to meet their revenue expenditure. The following table shows that the important sources of revenue for the states are state-owned taxes, state shares in the central taxes, state share in the tax proceeds of the central government, grant in aid and other contributions from the center, and states' own non-tax revenue. Revenue of the state governments on revenue account. As we can see that the revenue of the state governments on revenue account in 1950-51 was just 280 crores, which rose to 5,52,243 crores in 2009-2010. And the grants from states from the center increased from just 30 crores in 1951-52 to the tune of 1,68,683 crores in 2009-2010. Overall total receipts, we can see that in 1951-52 was just 400 crores, which rose to 8,04,943 crores in 2009-2010. Non-development expenditure. The single largest non-development expenditure of the states is payment of interest. As we can see, in 2009-2010, the states are expected to pay 11,64,427 crores, that is 36.8% of the total non-development expenditure on account of interest payments. These payments are made partly to the central government and partly to the markets from where the loans have been raised. The second largest item of the non-development expenditure is the pensions. Now it was 1,357 crores, or we can say 31.7% of the non-plan expenditure. The third largest item of non-plan expenditure of the states is on the administrative services, which includes secretarial, general services, district administration, police, public works, etc. Development expenditure. The development expenditure is divided into two parts, mainly social and community services and the economic services. Expenditure on social and community services is incurred on services like education, family planning, public health, housing, labor, employment, social security and welfare, natural calamities handling, and all that. These form an essential part of the expenditure of the states. Expenditure on economic services consists of expenditure on agriculture, veterinary and cooperative services, irrigation, electricity, rural and community development projects, civil projects, industries and minerals, etc. Trends in revenue and expenditure of the central and state governments. This table shows the combined picture of the total revenue and expenditure of the center and the union territories. As we can see that from this table that in less than 5 decades between 1960-61 to 2009-2010, the combined total expenditure of the center and the states has risen from rupees 36,850 crores to 18,92,880 crores, which is over 40 times. Now the combined total expenditure of the center and state consists of development expenditure and non-development expenditure of all types and compensation and assignments made by states to the local governments and Panchayati Raj institutions. During the same period, the combined current receipts of the center and the states rose from 24,570 crores to the tune of 12,08,804 crores. The total revenue consists of total revenue of the center and the state, non-tax revenue receipts of the center and the states, non-debt capital receipts consisting of loans and advances. Now students, let us try to summarize what we have learned from this module. One of the key objectives of having the budgets of the state governments and the central governments is to ensure stability. In fact, stability is more important than the growth. As we can see from the last couple of years that though we were passing through a very challenging kind of phase whereby it was expected that we should focus on more growth, but the government of India adopted a policy of stabilization. Now, though our country wants to come up with a higher rate of growth and to touch a 9% GDP growth or also to touch a double-digit rate of growth barrier. But the government focused on stability part, which is more associated or which is more suitable for the larger masses. Government wants inclusive growth. In fact, if we want good development, development should be inclusive development, and for that purpose, stability is more important. That is what the government has been doing. Now, when we look at the budgets of the union government and state government, one of the interesting trend which we have seen from the statistics is that over a period of time, the emphasis on non-plan expenditures have increased, and that non-plan expenditure is reducing the investment ratio of the government. Now, when the investment by the government is decreasing, that means that growth in the long run will be adversely affected. So, in order to ensure this, the emphasis on non-plan expenditure should be decreased and more emphasis should be on the planned expenditure. And for this purpose, a serious introspection is required, and we need to understand all these statistics in a better way so that we can ensure more and more growth in the years to come by increasing the planned expenditure and also by ensuring the inclusive growth.